We're speaking with James Tworek from Element79 Gold. He's the CEO over there. And then with Lucero, that's was that an average grade of 19 grams per ton equivalent?
That's right. So Lucero, in its past 5 years, or sorry, 6 years, building up to 2005 when it was closed, was producing on average, it was extracting about 150 tons per day of average ore extraction during that time. And it was yielding between 40 and 50,000 ounces of gold equivalent. So obviously very high grade. Every scoop you pull out of the ground there is that much more efficient than other actively producing mines. To throw a benchmark out there, the Bald Mountain mine, which I just mentioned, is producing at roughly half a gram per ton.
Yeah.
So in an order of magnitude, this is, on a gold equivalency basis, an order of magnitude greater. It's that much more efficient. And we don't have to, in the short run, build our own infrastructure, as I had already mentioned, that there is local infrastructure that we can basically, extract that ore, maybe work through an ore separating program, and in conjunction with that off-taker, go ahead and look at moving the product to them. So it doesn't cost us massive capex up front to be able to do that, and it's still economically viable in terms of proximity.
And so that property, what would it take? Are you going to do a lot more like survey, thermal, anything, or are you going to do some drilling, or what's going to happen there? Are you going to try to look for more ounces, build it out? What's some of the plan with that?
Being that it's such a large property, 26,000 acres at the top of a mountain, obviously it's quite a diverse area. To give you a bit of an overlay, there are 74 veins at surface on this property. As my understanding and the team's understanding is, only about 14 of those veins have ever been explored where there are adits. And realistically, all of that former production only came from 7 of those veins.
All right.
So great opportunity in terms of upside. Number one, in terms of not just working with the existing existing veins that are known and have previously yielded commercial production, but also exploring what is known there, let alone proving up further resources, perhaps looking at this through drilling, to try and prove up an open pit concept on several of them that are closer to each other. In addition to, in the northwest, you'll see this on the map, and there's kind of an oval that's been identified in the kind of central northwest portion or quadrant of the map, where it identifies that there is a high sulfidation target, which is yet to be proven by anybody. It's never been touched by a drill, but that's a great opportunity to prove up an oxidation deposit there. And we do look forward to that in future unveilings of work plans. So as we ramp up, number one, obviously, having an eye on proving up the existing resources from the existing veins, and then perhaps exploring some of the additional veins. And then number two, also probably a healthy drill plan of $2 to $3 million to prove up that sulfidation target. Going to a depth of somewhere in the 200 to 300 meter range would be sufficient to prove that up and help bring not just a resource on the books, but also from the existing veins, prove a life of mine so that we can actually get to production.
I like to bring up some stuff that might seem totally obvious, because I have a lot of generalist investors that watch, and sometimes they'll ask, they'll go, I don't understand. Why wouldn't they go explore these other veins? Or if there was still material in there, why wouldn't they just take it out? And I mean, it's to you and me, it would seem very obvious. Like, well, the price of gold back when they would have stopped is nothing near 2000. So
Sure.
It just became uneconomic. And you can imagine costly, so this is to subscribers, it's very costly to drill and to keep drilling. This now becomes much more exciting at $2,000. And
absolutely. And to pair with that, Antonios, who is a mining engineer who not only runs a 55-person consultancy that worked on about $3.5 billion of projects globally. Again, he was the CEO of this entity, and he is now of the entity that we acquired, I should say, and now is our COO. He and Kim Kirkland, our VP Exploration, have worked their understanding and numbers, and also based on past conversations with the potential off-taker, that we would estimate in the ballpark of roughly $1,000 as an all-in sustaining cost. And when you're talking about today, currently somewhere in the 1900, 1970 range, for gold, obviously that leaves a little bit of fat in the pig for us in terms of profit, not just going straight to the toll cost and the hauling cost, et cetera. They also do estimate that through obviously ramping up and ore separation on our own site, kind of setting higher grade and balancing out with the overall remaining feed at the potential off-taker, we will likely get our all-in sustaining costs downward over a couple of years of working with them. And again, the massive advantage to us, I mean, we have been in touch with mining, the funding groups that would do the infrastructure finance and so on, whether private and or public and or global level, very well big name type firms. Those groups, estimate it would be somewhere in the range of something like $25 to $35 million of infrastructure, which again, if you're cash flowing, obviously not a problem to pay for a debt facility to do so. But in the short run, if we can just use local infrastructure, the roads are great intact. This is a previously producing mine. The locals have, between trucking and extraction facilities and equipment, there's a lot going for us in terms of the ability to really put this back into motion. But we're not going to do it without making sure that we have a reliable and responsible access to a resource, meaning a life of mine, in that kind of 3 to 8 year range, to feel comfortable about going where we're going.